It gives me great pleasure now to bring on board Charandeep Singh, founder and managing director of Girik Capital, and his co-founder Varun Daga. Gentlemen, good morning. Thank you for joining us. All right, guys, India Mart is at 5,200. Let me see who smiles more. Will it be Varun or will it be Charandeep?
Good morning. Nikunj, how are you?
I was hoping for a slightly more, energetic start, guys. India Mart is at 5,200. I'll say it again. Fantastic to have you back. I'll talk about why you liked some of the platform companies, but let me first get a broad market view from you. What's going on? Are you comfortable with the kind of market valuations and the levels we are staring at?
Yeah, hi. I'll just start with a quick quote, a very famous quote from Sir John Templeton. I'm reading it. So, he says, bull markets are born on pessimism, grow on skepticism, mature on optimism, and they die on euphoria. I think this is very, very relevant. And I just, I'm sure Varun has some things to say, but I actually believe that this is so relevant for times like ours, because we've gone through such a great cycle of optimism and then pessimism, probably skepticism now, So I think, maybe we should take some inspiration from that quote of Sir John Templeton. Very hard to predict markets, but so I won't really comment on that. But, I think that what's being said here is very relevant by him.
Okay, now, Varun, Sir John Templeton believes in buying fear and greed, but Howard Marks, also a global guru, has the following to say about global markets. There is no cynicism. There is a lot of optimism. Everybody is buying as if they are going to miss a train. So while it's good to revisit Sir John Templeton, Howard Marks is saying that there is a bubble in making in US tech stocks.
It's very possible. These are all great gurus. But what we believe is that, you have to, of course, keep an open mind. What we hear, whoever you talk to on the street, everybody is like, how is the market going up? The economy is in a bad shape. How is the stock market going up? So that's usually a great sign for the market, because nobody can make sense. And there are not enough reasons to believe that, market should go up. Many people say, I would short the market. And why is Reliance going up so much? There is no reason for it to go up. So these are all good signs. Having said that, of course, in the short run, there could be a bit of euphoria. But we believe that over a longer period, the way the bull market is playing out, the way we've come out of this crisis, and how companies are performing, and how leaders are actually showing strength, even in terms of numbers, not just price. It's quite amazing how they have adapted to the change. So that's what we are looking for. We are not great predictors of market, but we will try to follow it and do the best we can.
Charandeep, if I scan through your portfolio, you as a fund house are following a very differentiated strategy. What you are doing essentially, and correct me if my interpretation is wrong, you're morphing your portfolio to the new world, which is a Reliance, a Bharti, a India Mart. Basically, what you're telling the world is that you are very bullish on the so-called platform companies and the way how the world has taken a digital leap. There is no cement, there is no auto, there is hardly any traditional IT services. What you right now have are the new age digital businesses.
Right. Actually, Nikunj, that's a really good observation, because we were having our Monday morning call in the office yesterday when we were going over our portfolio. What we typically do is we set aside some time to look at portfolio concentrations, industry concentration. Are we well balanced between small, mid, and large cap? How many illiquids do we have in our portfolio? We go through this risk management exercise. which is very important, and we do it in a very process-driven and disciplined manner. One observation that came to the fore between the two of us, or rather between our team, was that a lot of our companies are, so to speak, digital ready. If you look at many of them, they are great companies. They have superb leadership, great management, no governance issues. They are true leaders with accelerating earnings. But you know what all of these companies have done over the years? They have invested far in advance of not knowing a pandemic was coming. They've invested in great IT. They've invested in great HR personnel. They've invested in ensuring that they're always digital proof, IT enabled and technology ready, such that they can take leadership when the tough times come. So it's very easy for such companies to take market share at a time like this. The large is Darwinian. The large get larger. And I think this is a time when, unfortunately or fortunately, that is happening. So I think great observation on your part that, yes, a lot of the platforms that we are invested in are digital ready. As far as you said some of the old economy stocks, I would like to just take a step back and say, that, in fact, I remember even in our last conversation, we discussed some of these names. They were very early on our screeners. These companies were throwing up very early for their leadership and their earnings potential and the earnings growth that we expect from them over the next several years. So not only these companies are digital enablers, they also came up very early on our screener for the quality of earnings momentum that they are showing. So, in a sense, yes, it's all come together pretty nicely and the portfolio has a lot of these digital leaders. It's not really by design, I would say. As far as old economy stocks are concerned, no, I'm sure they will have their time. I don't know. As of now, we don't necessarily see them as real money-making opportunities. But, let's not call them old economy stocks. I think IT services stocks aren't necessarily old economy stocks. They also benefit from the pandemic. The sector, it's showing up very regularly on our screeners. It's just a question of what to buy. Something has to fit all your criteria and something has to make money for the investor. And that's really why we do this. The eye is on the bottom line. It's not our own ego or our own thesis. The ultimate aim is to make money for the investor.
That's a great point. Never lose sight of risk and never lose sight of opportunity. Varun, I'm just trying to understand for the benefit of our viewers, the stocks which you own, how are you really valuing them? Because if I use the traditional tool, the favorite tool which all of us use is PE, price to P multiple. Based on that, let's say Jubilant or India Mart, some of these stocks will be qualifying as expensive stocks, yet you like them. So how are you valuing them and why do you think they still have scope to make money?
Sure. Great question, Nikunj. And I think it's one of the most talked about topic, which is the PE ratio. Everybody is so micro-focused on PE ratio. But, I think there are many ways to evaluate a stock. A high PE does not mean it's expensive. Low PE does not mean it's cheap. So there are a lot of times, we look at a high PE stock and we say it's very expensive. But what we really need to understand that, okay, today's high PE stock, can it be much cheaper 5 years down the line? Most of the people miss the biggest winners, and including some of the great investors, because it looks expensive on the face of it. It looks expensive in terms of the PE ratio. Many people don't even get through the company, don't even start analyzing the company and the fundamentals of the company because it looks expensive on the PE multiple. So we differentiate in that way. What we do is, before even getting in terms of the valuation, we first establish leadership. And we totally recommend that before getting to valuation, one must establish leadership, the potential of the growth, the scope of the growth of the company, the management quality, the governance. I think most of these, when we tick all these criteria, you realize that the stock is still expensive, right? You in a PE multiple basis. But what happens is when you get into the fundamentals and you realize that, okay, look, the leadership is huge, the size of the opportunity is massive, and this company could be, probably 5 times the size in the next 5-7 years. So when we look at that, I think that the PE multiple is a very, very small part of the puzzle. What we need to understand is how big that company could be. What is the scope of the opportunity? So, for example, let's look at Reliance. When we first bought it, it was maybe around 8-9 lakh crore market cap. And what happened was that we started seeing this ARPUs going up. And just a simple math when we did about Jio, that, okay, he's at 40 crore subscribers. Can he get to a 60 crore subscribers or 50 crore subscribers in the next 5 years? And can the ARPUs go back to 300 levels, which was there 5 years ago? So can the ARPUs go back to the same level in 5 years, which was 5 years ago? If that happens, you could be seeing profit as large, a cash profit as large as 1 lakh crore just from Jio alone. So whether that happens in the next 5 years, 3 years, or 7 years, that is one needs to evaluate. But the scope of opportunity is big. Whether the ARPUs go to 300 or 500, that's need to be seen. But the scope of opportunity is very big. So if a Reliance can earn a 1 lakh crore, that at a 9 lakh crore, it's very cheap. That's just for Jio. Then there is retail, then there is petrochemical. So this is what we need to see first, and then come back to the valuation part, that, okay, what price you want to buy it, what levels you want to buy it. But I think establishing leadership and the scope of growth is the first step we look at.
Great point. Now, Charandeep, while I understand that you like to buy leadership companies, why do you have both Bharti and Reliance in your portfolio? And given that the dynamics of the telecom sector are still not stable, Bharti has not been able to consider a price hike. They will have to shell out a lot in 5G. The promoters sold out at higher level. Is your thesis of owning Bharti, is it turning sour now?
Not yet. I wouldn't say that's the case yet. See, we are in the very early stages of a possible duopoly type situation, right? And you know for sure that at worst, there are going to be 3 competitors, right? I think it's too early to throw in the towel and say that, look, this is not a money-making opportunity. This is not a secular opportunity, because you have potential price hikes coming here, right? Now, the question is, yes, if they don't come or if they are delayed, that backends the thesis. So there is a possibility, and look, in the market or when you're making investments, you can do all your work, but ultimately you're playing with a range of outcomes and possibilities, right? Not everything's going to go in the direction that you want, in the timeline that you want. But I think short answer to your question is duopoly-like situation, 2 well-funded competitors, and all the price war being behind us, the profit pool for the entire industry grows. So we believe all should benefit. Potentially all 3 should benefit. Let's see what happens. I think that the next 6 or 9 months will at least give us some idea as to whether our thesis is in the right direction. But basis historicals, it's clearly a tough investment. The leadership is there. The earnings acceleration is not there. So certain things are there and certain things are not there. Let's see if that changes in the next 6 months to 1 year.
Varun, where else do you see this kind of an market share shift or concentration happening, where currently it could be COVID, it could be the efficiency cycle, it could be pure amalgamation of the business, where you think that leadership is going to will change and concentration will emerge more?
Nikunj, I think this is happening in every industry. If you look at how things are shifting, the leaders are becoming bigger. They are well funded. They have capital, and the small guys are losing the business. So whether it is pharma or chemical or whichever sector which you look, most of the sectors, the leadership is taking the market share, because the smaller guys are not technologically enabled. They are not able to cope up with the pandemic. They're not able to attract the right talent. So this is probably one of the biggest period where you're going to see more and more consolidation, where you're going to see more and more leadership emerge, and the leaders will get more and more business. So I think I wouldn't name any specific sector, but across the industry, across sectors, this is the common trend, because and this has come as a jolt to most of the smaller guys who are not ready for the change, so and who have not able to adapt. I mean, look at the restaurant business, for example. Why is Jubilant taking market share? Because nobody else has been so ready how Jubilant has been. So you will see the smaller guys, you will see the leaders and the bigger guys take market share from the smaller players, and the technology will be a big big enabler for doing that. So that's what we believe.
Charandeep, got to ask you on what was the playbook or what were the factors that play which in a sense convinced you and Varun to buy India Mart, because that stock has given great returns. And are you not worried about a disruption which could come because of Jio or Reliance or Amazon?
So I tell you our thesis. I mean, our thesis is about maybe a year old in this. But basically, you see, we noticed this company at the time of the IPO. We did some work. We tried to really understand the history of the people, the history of the platform. What really did it for us was the customer validation that we heard about. This all started when we were on one day, we were playing golf with a friend. And he actually mentioned to us that, look, I do business with these guys. He's one of the largest distributors in his segment in the state. He said, look, I do business with these guys. You should check them out. They do phenomenal work. And, many of us in our industry, in our segments, don't really have a business without them. They're very good at what they do. And the customer feedback we found was overall excellent. That got us really started with this company that you're talking about. And we found that, they have created a sort of network effect. If you look at any website or if you typically look at any app, once you get a network on it of buyers and sellers or of viewers, that's when the traction really starts kicking in. So I think that, we found that the numbers were very compelling. And the interesting thing is that post-COVID and through the COVID crisis, you've had the visits to the site shoot up. They're going up even more. So yes, one would say we got in for possibly the right reasons and possibly for, something that was to play out over many years. And, things like COVID have only helped the business case. You will now have more viewers, or rather more users, which probably results in more paid subscribers, because the paid subscriber base out of the registered user base is very small. One more thing we liked about it is that it collects all its money upfront. All the revenues are collected upfront. So there's a lot of visibility here. I think to your question about things like Jio, etc., there's always that risk, right, of competition coming in. There's Jio, there's Udaan. There are several people who would try to do this. Why would anybody leave an SME market in India of such a large magnitude? But I can tell you one thing, organizing such unorganized markets, mom and pops, is a very, very difficult thing to do. You look at the China example. India is very similar in its demographic profile, in its base of SMEs. In fact, over here, if you are able to provide an SME a service wherein they're able to reach their customers better and easier, that creates massive loyalty and it creates huge stickiness. So the call to make here really is, have they crossed that inflection point? Do they have the critical mass to be able to sustain this and grow this? These are all the positives. I would say, when you look at a negative, you say, yes, as fund managers, we have to keep rebalancing our portfolios. When things run up this quickly, we do the right thing. We rebalance our portfolio. So we do a little bit of profit taking here and there. So I hope that answers your question. I think the question on Jio, I would not be in a position to answer beyond a point, but I can tell you network effects over here on digital platforms are very, very powerful. And I think that they are very hard to displace. Arguably, they could be an acquisition candidate for somebody big who wants to come into India, etc., etc. That would be my take on this.
It's a great point. It's a great point, and thank you for very briefly and nicely articulating your thought process. I'm just trying to bring out your thought process because, like I said at the beginning of the show, seldom do you see funds which are running a portfolio which is not really hugging on to the Nifty or to the benchmark, and they are now trying to really make it future ready. It's very important. I mean, for the longest time, just for the benefit of our folks, Varun and Charandeep are making this point that we've heard the word value argument, sasta hai, low P hai, high dividend yield, stock le lo. But what Girik is doing is saying that, look, we are in a different world and we must recognize that, and that's what I think they're trying to communicate to their investors by owning some of these stocks. So Varun, can I say that a stock like SBI, NTPC, ITC, these stocks will not come in your portfolio? Are you averse to buying stocks which are cheap, which give you a grandeur on dividend yield?
Look, Nikunj, we follow a very, very, very defined process. We have our screeners, and we do not go out of those screeners. So we do not have our bias, our ego, or our past experience. So maybe if we've made money in the past in ITC, doesn't mean that we're going to buy it even if it's cheap. So it has to fall in the criteria of our screeners, which is a blend of earnings growth, which is a blend of the right industry, which is also a blend of the price. Because we do not want to miss anything, at least to evaluate, we do not want to miss anything that is going up in price, which is showing price leadership, which is showing industry leadership, and which is showing earnings growth. So, I mean, if ITC or SBI or NTPC, if they come up on our screener, we will look at it with a very unbiased view, and we will definitely look at it, and try to make a case, because if the screeners are telling us, then we must look at it. So we follow a very, very diligent process, and we do not move out of that discipline. So we truly believe that, I mean, the most important thing is discipline. You could be the most intelligent person, but we've seen many intelligent people go broke because they were not disciplined. So idea is to remain disciplined and follow our system.
I'm going to wrap it up with a stock which you perhaps own, track, and understand much deeply than anyone else because of your old association, and that is HDFC Bank. There is a change of guard, and there are examples, Charandeep, where we can say change of guard in financials does matter. I can also give you examples where change of the guard does not matter, because if the company and if the bank is institutional driven. How should investors look at the change of guard for HDFC Bank once Mr. Puri steps down? I mean, he's created an institution, he's a legend. Will shareholders miss him, or he's leaving a ship which is in fine shape?
Yes. I think, the whole street's talking about this. And I think, the way we at Girik would evaluate something like this is we would look at a leadership change very closely. See, look, let's put things into perspective. HDFC Bank are great institutions. The people that are behind these institutions are extremely professional, extremely diligent, process-driven. They have great talent. They have highly professional boards. So they have leadership, they have governance, they have the history of delivery. I mean, you really can't beat that. You're talking about possibly the institution in India, right? The institution, because they're number one across every vertical that they operate in. They're not number two, they're number one, virtually everywhere. So, to question them and to question their decisions, who are we? But yes, I think what you're saying is that there is a leadership change today at the bank. And will this go well? I think it remains to be seen. Of course, it's not easy to grow an institution that is this large because you just have so much size, right? You're already so large. A 10 lakh crore balance sheet to become a 30 lakh crore balance sheet, I mean, it may take a long time. You may not necessarily have the growth, but, with such phenomenal raw materials, such great systems and such great people in place, you have to bet that even if these institutions get it wrong in the short term, I'm not saying this is a bad or a good decision to hire the gentleman that they've hired, or rather to promote him to MD. But institutions like this ultimately go back and get it right. You look at Infosys, the great company that it is, right? it had governance issues or so-called governance issues. It had leadership issues. It had so many people change over the last decade. But you know what? Governance kicks in. There are people out there watching that genuinely empowered boards who will ensure that you get the right person in the place to run the institution. The raw material doesn't go away. It's very hard to displace that. So I think the same of HDFC Bank. And it's possible that you could have a decade of no returns. Investors just have to be mentally prepared for that. So there are two things. One is the decision correct? Will it work out? That's a different matter. Will the investment be a good investment? And how much time do you have as an investor? So if you go into a period of 10 years of no returns, are you willing to live with it? This is something that investors must always be aware of when they are buying something. They must have their thesis, their process, and their discipline intact. So two different things which I'm trying to highlight over here.
Well, thank you very much. I guess, stock return is never linear. That is what I think we also must remind our viewers once again. All right, fantastic, gentlemen. Thank you for joining us, and thank you for sharing your thoughts so openly and so freely.
Great.
Thank you so much, Nikunj.
Thanks for having us.
Let's take a break. When we come back, thank you very much.